Welcome to the first Money Talk show of the decade. We're only 1 week into 2020 and markets have already seen some turbulence, especially in oil and gold. Rising tension in the Middle East hit a boiling point with the U.S. killing Iran's top general, which then triggered a missile attack from Iran. Here to break down what the latest conflict could mean for oil and gold is Bart Mellick. He is Global Head of Commodity Strategy at TD Securities. It's great to have you here.
Great to be here.
And Happy New Year. Despite what's going on, we'll still say Happy New Year. Let me just start with what does this mean for oil prices? Because we saw them move up with the killing of the Iranian general. Then we saw them move back down below the levels when things seems to have subsided a bit. So what do you see?
Well, we see maybe a bit of a pause for now. We were a little bit negative on oil in November or so. We've recently have increased our outlook. The reason we have is we essentially expect more risk in the oil price. Essentially, we think there is a bit of a risk premium now. We don't think there's an escalation at this point in the hostilities between these two nations, but I think it becomes a possibility. And now the market is thinking that there could be things that happen as we go deeper into 22. Whether they do or not, we're not sure, but the risk exists.
Can you give us a little more background on what those risks? I mean, there's a Middle Eastern, geopolitical premium, but like what? What could we see?
Well, certainly the market was quite worried that there might be a cycle evolving of tit-for-tat type of response where the United States knocked out the general. Then Iran was feared could have gone after assets in Saudi Arabia, for example. We've seen that happen already where 5 million barrels per day of capacity was knocked out. So that would be a scenario that would basically leave the world short of oil, and we could easily see triple-digit WTI. Another scenario the markets were worried about is potentially going against shipping in the Gulf, the Straits of Hormuz, essentially knocking out tanker traffic. That too would interrupt flow of roughly 20 million barrels a day worth of distillates and oil. That would be irreplaceable and could very much shift the market into a massive, massive deficit and certainly higher prices. Okay,
so those are the conditions in which you would see triple digits. If those did not happen, what are you seeing for oil in the next, say, year?
Well, we're looking at about $60 for the rest of the year. We have that geopolitical risk premium, maybe $4 or so embedded in our price for the first half and somewhat less into the latter part of the year.
For investors who are looking to play this, I mean, there's lots of different ways they can, but what do you suggest? I mean, sometimes it's safer to look, for people who are doing commodities like yourself, that's not everybody's going to be able to do that. But, ETFs, but even the oil companies, because it's only at certain levels to become profitable for the producers.
Well, certainly at these levels, a lot of the marginal companies that were having difficult time at $50, $55, in essence, where they've hedged, are now viable. So since it is based on the differential between cost and price, $60, I think, puts a lot of smaller companies in the shale in the money, and certainly high-cost producers as well. So higher prices make them more profitable, and that should respond as a result.
All right, we'll be watching those headlines to see what happens. Oil. Let's shift to gold. Obviously, the safety haven for everyone, and we saw gold move a lot last night. Well, we saw things move around, but I'm settling back a little bit. But what do you see? Where's gold now, and where do you see it going?
Well, gold has been doing well before these attacks, mainly on the hypothesis that we will continue to see very low interest rates and continued monetary accommodation from the Federal Reserve and potentially other central banks. We're seeing these liquidity injections done by the Federal Reserve to help the plumbing, but nonetheless, that is providing liquidity to the whole system. And we are also looking at an environment where, yes, growth will not move into recessionary levels, we don't think, but it will most likely be weaker than it was last year. And there exists a chance that the Federal Reserve, in fact, TD Securities believes that the Federal Reserve cuts rates 2 more times. And then we've had enter this issue with the rocket launches and the gold surge. Well, the problem there was that we could see an economy that weakens because of the negative supply shock from oil. Higher oil prices could slow the economy, and at the same time, we could see price pressure. And the belief, I think, by most people was...
price pressure with gold?
with oil.
Inflation. Okay.
With inflation, and then the assumption was that Federal Reserve and the central banks around the world would absorb that supply shock, that negative supply shock, with accommodative monetary policy. So you would have real rates that would go down and low rates. So you would theoretically have fairly high prices, slower economic activity, and rates that were forced lower. You know, your classic stagflationary type of environment, which we think would probably be good for gold. But that reversed as those risks abated.
Right. So right now we're seeing gold in around, like, I think it's 57 area. So where do you, I mean, I'm not going to ask for a year prediction. That's a long time. But what do you see in the next little while, the range?
Well, I think we should probably see a bit of a correction still as those tensions get priced out. What we're looking at is essentially lower interest rates still, and equity markets that are doing well. So some of that premium should be moved out of that market, in our view. And it's a fairly crowded trade. Essentially, there's a lot of long positions out there, and I think we're going to knock some of them. That'll probably be profit-taking. But longer term, we like gold. We like it at $1,650, but that's more towards the end of the year.
Okay. Well, we'll have you back to see how that plays out. Bart, always a pleasure.
Thank you.
Bart Melek, he's Global Head of Commodity Strategy at TD Securities. And while the Middle East conflict could have a big impact on gold, Michael Craig, Head of Asset Allocation at TD Asset Management, says conditions are quite supportive of equity markets right now as he sees growth starting to reaccelerate. If you want to watch that whole interview, you can watch it at moneytalkgo.com.